All right, great. So yeah, so what we're going to talk about today is understanding how the banks trade and how to manage your losses to grow your account. Now, let me tell you why this came about, why I decided that I wanted to teach a little bit on this topic today, because ever since I got into this space, a lot of you have heard stuff called the market makers. These are the people that control the market. I've heard everything. There's a conspiracy. They're just trying to get our money so they could take it. I heard that they get in and they control the market. There's no point that you can't make $1 million in this thing because there's other forces that control it. The Illuminati got it. This got it. The Rothschilds own it. They do this. Well, guys, I'm not going to say that that's totally untrue. Okay. But what I wanted to do is I really wanted to understand, okay, well, who's actually taking my money? That's one thing. Like if I get robbed, I at least want to find out, well, who's the criminals? Okay. Can the police find out who the criminals were at least? I want to know who at least attempted to try to take my money. If somebody embezzled some money from me, hey, I need to find out who how'd they get over on me? I want to find out how that money was embezzled. So I think if you understand that, guess what you can do? Once you understand who the opposite force is, once you understand who's on the other side of the table, guess what? Now you can understand how to have an offense and a defense with that. Okay, I hope that makes sense. I really want to share this with you because if you understand how the banks operate and how they manage to trade millions and millions and millions of dollars on a daily basis, then I believe we can take that knowledge and then you can learn how to do our hundreds and thousands of dollars and operate kind of the same way the banks do, because this is how they become rich. And so that's kind of why I wanted to share that. Another reason I really wanted to touch base on this is because a lot of us are still puzzled and question ourselves in our trading. We're like, well, so every time I get in, it reversed the other way. I don't get it. I'm doing my confirmations. I'm doing this. And the trend seems to be doing this, but it goes the other way. And we all have come into the space where we say the trend is your friend. But I'm going to kind of share some opposite information that might shift your paradigm a little bit, okay? Because yes, the trend can be your friend, but guess what? Even like friends, they can turn on you. So I want you to understand when your friends are turning on you, okay? So that you can defend yourself in these turns, okay? So that's what we're going to talk about today. So let's get your pen, paper out. Let's take a few little notes, and then I'm going to really kind of break this thing down to you so you guys have a better understanding of how the markets really work, okay? All right. So first and foremost, okay, banks do influence the Forex market, okay? And if you didn't know, here are five main banks that influence the Forex market. These are called world banks, also known as central banks, okay? And so if you didn't know that, we have Deutsche Bank, JP Morgan Chase, HSBC, Citibank, and yes, there's been some rumors that a couple Chinese banks have been trying to come in. And I'm going to break that down a little bit on why that is. All right. So now, one of the questions I had earlier when I talked to a gentleman from our UK family, he said, well, Shawn, what is it about these particular banks? Why do these banks seem to influence the market? What is special about these? Well, here's what I want you to know, that these banks are privately owned. Okay, they are not a government agency. They're not a agency of the state. They're not property of the state. These are families, private families that own these particular banks. So again, if you do some of your research, which I always encourage you to do so that you can understand the space that you're in, you have the Rothschilds. Okay, the Rothschilds own, the Bank of England, the bank, here in the United States. I mean, they're the backers in some of that, okay? The Rockefellers, you've heard that name before too. That's some JP Morgan, Morgan Chase. This is a family. JP Morgan isn't just a catchy name. This is actually a family that owns these banks, okay? And HSBC, Citibank, and all those. So there's private money that's behind us that controls, the stockpiles of money around the world. Okay, now I know that may be shocking to some of you. You say, well, I just think it's just a regular bank. They are, but guess what? They were started by families. And so that's who really controls it, okay? So the world banks, they siphon money and share money with what they call interbanks, okay? What are interbanks? Interbanks are banks designated to buy and sell foreign currencies all around the world, okay? So the big money, the World Bank comes at these five main banks here at the top. At least four for sure. I'll say at least four. Okay, I don't know what the fifth one is specifically, but four for sure. And then what they do is they kind of siphon money down to the interbanks where they're able to purchase currencies and distribute that. And that's what we're going to kind of talk about. Okay. All right, so now what exactly do the banks do? How do they move this currency? How does this affect us as traders, okay? Well, first of all, the banks need liquidity, okay? They need liquid cash to make prices go up and down, okay? And so guess what? They take our money, okay, and they use it to put back into the market. So now I want you to imagine this. There's a reason, especially for people here in the United States, there's a reason that when you were depositing your checks before it's all coronavirus and you're working and doing stuff, you would have to deposit your bank before 2 p.m., okay, at your particular bank so that it could register for the next day. Obviously, if you do it after 2 p.m., what happens? You don't see your money until the day after, okay? And so there's a reason for that. People don't understand. The reason for that, guys, is because they take your money that's in the banks and you see the Brinks truck, you see the armored trucks. Do you understand that we're still in a time now where you can electronically do stuff? But why do armored trucks still come to a bank? You ever thought about that? Because, guys, they take that money and they're bringing it to an interbank, which from the interbank, they actually siphon up to one of the central banks or one of the world banks, okay? They're trading your money in the foreign currency exchange. So we've heard some of that. For some of you who've been in IM Master Academy from the beginning, you know, you've heard the splinters of, oh, you know, they take their money and you only get 0.1% of it, and then they take and they trade your money. Yeah, but here's the thing. You think they trade it at the bank. They don't trade it at that particular bank. No, they take the money out of the bank and they bring it up to the central banks, okay? And that's where they're going to go ahead and trade your money, okay? And so from that 2 p.m. up until 6 a.m. the next day, guess what? That money is depleted out and then is put back in, okay? Now, people say, well, Shawn, I look in my account at 12 at night, 1 in the morning, 2 in the morning, and it still tells me I have $2,000, I have $5,000, I have 12, I have $100,000. Absolutely. Electronically, they're always going to show you what your account balance is. But remember, that's electronic. Okay, that's something they're going to program, and that's what it's going to show. And of course, it's like any other Excel or accounting sheet of some sort. When you deduct and add, it's going to automatically update. Of course, but that system software has to update the system, and then it updates what the money is in your account. But now, here's what I want you to think about. If you decide, if every person at your bank, whoever you bank with, were to go in and say, I want to take out my money at 4 p.m. today, they're not going to have it. Okay, they cannot fund everybody's money in the bank. They don't even keep all your money in the bank. They're only required to keep about, I believe, about maybe 20% of all the money in any particular branch. Because that's why, you know, when they have a bank robbery, there's only but so much cash in the bank. Now they say, Shawn, we're covered by FDIC. Yes, they are covered by FDIC up to a certain amount, but the realistic part behind it, that if everybody in the country were to lose their money out of their bank, the federal government would not be able to cover everybody's losses. Okay, this is why when you want to deposit a certain amount over $5,000, used to be over $9,000. Okay, what you have to do? You had to go in the back, fill out a slip, tell the people why you want your money out of the bank. Okay, why did they do that? Now they changed it to where I was down to $5,000. You can't really, take out more than $5,000 out the bank. Okay, why do they do that? Well, guess what? Because they don't have the money there. So what you have to do is you have to fill out a form, find out what you need it for, which is your money, and then they send a request, and then a Brinks truck comes back the next day and they deposit more money to cover your withdrawal. But they do keep a percentage of money in the bank. Okay? So that's kind of explains some of the banking if you guys didn't know that, okay? They can do this because there's an endless supply of money in circulation in the markets, okay? So what I had to realize is, okay, when you blow an account, when you lost on the trade, when you looked at the broker and say, where did my money go? My question is, where does the money go? Oh, it goes to a broker somewhere out in space. Well, guess what? That money goes to the broker goes to the bank, okay, with that money, and then guess what? It goes up to the central banks. And then they recycle this whole process over again, okay? So this is the cyclic cyclic process of how the foreign exchange market is working. Okay, it's just one big cycle. Okay, one big cycle. So now that's what the banks do with our money. That's how they're able to fund it. So we got millions and millions of people in the Forex market, constantly putting money in the brokers, constantly up trading, down trading, all that other stuff. And of course, to get that money, you have to get it out of what? Your bank account. And so the money always will touch the bank. So now this goes back to, doing your taxes. Because of course, if you didn't know, and this is some of the questions I get when I'm setting up people, well, what about taxes? How do taxes work? Well, guess what? Most of your broker accounts are offshore accounts. If you ever thought about, a Swiss account, like we all say, oh, we see in the movies, he embezzled, $2 billion and he's hiding it in a Swiss account. Well, basically that just means that it's an account that's not regulated by a federal government. Okay. That means they're not in there counting every little penny trying to report to the government what you got. All right. Guess what? If you didn't know it, your broker account is just like a Swiss account. Okay. Most of these brokers are not regulated by any government agency. Okay. So you're putting money in there, you're trading. And so guess what? That money stays secure in there. Okay. Hopefully. Now there's a positive and there's a negative. The positive is, guess what? That money is secure. It's offshore. You ain't got to worry about it. Uncle Sam doesn't have his hand on it. Okay. But the problem is if the money is inaccurate or you have problems getting your money, you really don't have an agency to go by and complain about getting all your money out. Okay. Now, of course, we have brokers here in the United States, but they're way more conservative. They won't let you be aggressive as far as your lot size, as far as growing your account. That's why you don't hear a lot of us as traders use a lot of American accounts like that. Okay, like Owanda. Owanda is an American broker. I think there's a couple others. So that's kind of how the tax part works. The only time you get taxed is when you decide to withdraw money out of that broker account, because if you withdraw, where's it going to go? It's not like you could just call the broker and then they just come up with an envelope of cash, right? No, you got to deposit into what? A bank account. You see what I'm saying? And of course, the bank accounts are regulated by who? The government. So now the government knows you got, you made $1 million, you pulled out, 300,000 because you want to go ahead and get that Bentley, you want to get that Rolls Royce, you want to go ahead and put that down payment on your new home. Yeah, Uncle Sam's going to know that. So you have to report that. And because they're giving it out and sending it to your bank, they're going to have to send a notice out to say they did it. But if you kept that $1 million and you grew it to $10 million and you only pulled out $1 million, you only pay taxes on the $1 million. All right. I am not a CPA. Let me put this disclaimer out. I'm not a CPA. I'm not an advisor. I'm not a tax advisor of any sort. Please check with your own CPA and advisor to advise you on how to handle your taxes. Okay. So I just want to put that out there. But just for knowing purposes while being in here, this is how this whole banking thing works. Okay. So when you lose your money in your accounts, they go back to the big banks. All right. So now, let me kind of clear up some misconceptions of big banks, okay? Because this is what I was always curious about. I've heard it from our experts like Dr. Kathy and Manny Canones and all these, Christopher Terry, all these other experts. Well, I haven't really heard from Christopher Terry, but other people trading. I've heard stuff like, well, they can see your stop losses and they just purposely make everybody hit their stop losses so they can just take your money and go, and leave. So, it's a sham, it's a scam, it's, you can't really make any money. That's not really accurate right there. Okay. So let's go through some misconceptions. Another misconception is people think that banks have this superior software that tells where everybody's stop losses are in the trading. They can tell this and that and all these other things. So it's just a sham that you shouldn't trade. That's not true either. So let's go through some of these misconceptions. Okay. Number one, they cannot see your stop losses. Okay. But what they do is they can speculate, okay, on the areas of the major support and resistance areas. So let's take the other day when I did my class, a couple weeks ago where we did M's and W patterns, okay? And so what that just basically means, that for those of you who are brand new, is that how you trade, you can follow patterns because the market repeats itself over and over again. The reason that it repeats itself over and over again, ladies and gentlemen, is because it's geared by human nature, okay? Fear makes people sell. That's why the stock market plunged 1,000 points. People don't understand. That's human nature. It's not a computer that does it. It's not artificial intelligence that does it. It's people in their habits and their feelings that move the market. And if you can understand what we call sentiment, Okay, sentiment is just the feeling or the attitude that people are feeling, internally toward their money. That's what sentiment is. So if people feel fearful that they're going to lose their money, then people start to pull it out and they sell. That's a negative sentiment. All right. If people feel optimistic, like the economy is doing well, they hear some good news, there's new businesses. Well, guess what? Stocks, Forex, and everything, they rise. That's a positive sentiment. Okay. So when we marked up charts doing M and W periods, there's a area where most people, if I were to put up a chart right now, most of you are going to select the support and resistance in the same areas because that's how we learn. Well, guess what? If all of us who don't watch each other's charts or don't trade together on a regular basis, but I could take traders all in IM Master Academy and mark up the same chart, I bet you more than 90% of all of us would mark the same support and resistance in the same areas. If that's the case, if I can understand that, then why do we not think that banks understand that? They're going to speculate that everybody else must do it the same way. Okay. So that's the one misconception. They cannot physically see your stop loss because there's millions of people. It doesn't make sense to see just a million red lines in one area on a screen. That doesn't make any sense. No, they don't have that because there's over 20 million plus Forex traders at any given time of the day. So you don't want to be looking at a screen seeing 20 million red lines, right? Doesn't make any sense, guys. So what they do is they speculate on where they believe people may have their support and resistance areas, okay? The next thing that we'll talk about is called COT reports. I'm going to show you what a COT report is. I'm about to pull it up. It's called a commitment of traders. And so basically what this is, ladies and gentlemen, is it's kind of a summary of the sentiment. Remember I said it's how people feel about their money. It's going to give us a report of on certain quoted pairs, like a Euro USD, like a AUD JPY, like a Euro AUD. It's going to show us how much of the market is in a buy and how many are in a sell. So when you can get information like that, where you know where the majority of people are, well, you can now maneuver a certain way. You know what I'm saying? So that's kind of what we're going to show there, okay? And then, of course, banks look at the majority of positions long, which means buy, going up, or sell, short, going low. And then they move the market opposite to take your money, okay? So that's what they do. They look at the majority of where people are, and then they kind of set a trend in another way. Now, I don't want to give you, again, the bad feeling or misconception that the bank is your enemy, because that's not how they operate. Because here's the deal. If they're trying to be your enemy, then guess what? After a while, nobody's going to put money in the bank. Nobody's going to bother to trade. Okay, so that's not the intentions of what the banks are. So that's what I want to get into so you guys clearly understand, well, Shawn, what is the intentions of the bank? Why do they move opposite of the majority? All right, and so let me break this down. So banks use what they're doing is called accumulation and distribution. Accumulation and distribution. So here's what it is. When a bank wants to buy a currency, so this is how it works. So one of the central banks wants to buy the euro, okay, the euro dollar. Why? Because this is how they make their money. They get the currencies and they're selling it to other countries. They're selling it to other countries. Okay, that's how banks make their money. The banks don't make money with just money sitting in the bank. If it's not moving, they can't make money. So money has to move. Hence the name currency. Okay, it's a current. It moves. It has to move for them to make money. So in one area, banks are buying currency and they buy it at a discounted price. Okay, and so here's what happens. I'm going to show you a physical representation so you guys can understand it. So when we're in a downtrend and the price goes down, this is the time that banks want to buy when it's in a sell. So everybody's selling, selling, selling. So here's what I want you to think about. Think of a liquidation sale. For all my ladies who like to shop, for us men who like great deals, think of a liquidation sale, okay? Let's say our favorite store, it has normal prices. Most of the year has normal prices, but you know, Christmas, Black Friday, all these other places, they start to discount stuff, okay? They start to discount. So let's say they have a liquidation sale though, going out of business, or it's just out with the old into the new. Okay, we got 2019 old stuff. We're bringing in a new decade. We got new stuff. Everything's marked half off. So now what do? Normally at normal prices, what you're going to do? You're going to buy one or two of something. Let's take a winter coat or let's take some shoes. Okay, you're going to buy one coat, the one coat at normal price, probably about $75, right? But guess what? We got a liquidation sale and we got coats for $5, but you got to come in and get a bulk of it. So you're coming in getting 20 coats. You're coming in getting 40 coats. You're coming in getting, 50 coats, and you're getting them at $5 a piece. Okay, so that's what a sale is. It goes down in price, and the banks come in and they're getting a liquidation on the currency. As it gets cheaper and cheaper, they're buying it by the millions. Okay, now they have to do this in waves. They can't just go in and take, $5 billion and just purchase currency. If they do, guys, it's going to make the market crash. That's when you see those big, long, those big long red candles that go straight down 150 to 200 pips, just like what we saw with the stock market. We see one big long giant candle. Well, that's because all of a sudden the price of the dollar dropped, okay, because everybody was scared. So banks do this all the time. They buy it at certain intervals, okay, so that they are not making the market crash. So they have to get it as it gets cheaper. Now, guess what? They get all the money in their inventory. Well, we need 5 billion of euro. We need 3 billion of JPY. We need 10 billion of the franc. Okay, and so once they meet that quota, guess what? I told you they can't make money with money sitting there. They got to give it out. They got to make it move. So what they do is they start to sell it. Well, they don't sell it when everybody is selling. Guess what? They sell it as the price goes up. Because now let's take the example of the liquidation sale. You got five Armani winter jackets that were normally $75 to $100, but guess what? You got it for $5 a piece. So now it's winter time, okay? You got an Armani jacket that you only pay $5 each. Guess what? What you gonna sell it for once the price goes up? Once it's cold, people looking for a coat, man, I got a new coat for you. $75, look, $125, $128, $130. You see what I'm saying? That's exactly how the banks do it. So as soon as they meet their accumulation, they now start the distribution. And now they start at different intervals. They got to just put a few million out here, put a few million out for sale here, a few out here. They do it in waves. Because again, if they take their $20 billion and throw it in the market, now you got a up candle is going straight up, and you can hurt the market that way. All right, so they don't do that. Okay, so number two, the bank's concept is to always buy low, okay, when no one else wants to buy it high, okay, and sell high when no one wants to sell. Okay, so they move opposite of what the masses do. Why? Because this is where they're going to make their money. When the banks have accumulated all the currency they want in their inventory, then they will distribute the currencies on the way up on a buy trend in intervals to make their money. So let me go ahead and show you some things, okay? And then I'm going to show you the trend. Okay, so here's the thing. Banks fight against the trend. Okay, we learned that the trend is our friend. Well, as a retail trader, that's what we're called, retail traders, the mom and pops, the onesies, twosies, all of us little traders, okay, they don't care about a trend. They only care about as soon as they accumulate what they're looking for, then they go ahead and start selling it. Let's take it back at the liquidation sale that I was talking about. Once you've gotten all the jackets that you want to get, you've gotten, 20 jackets for $5. You got 50 shirts for $2 a piece. You got this. Once you have gotten all that you need, what do? You start selling it. All right. You may not even wait till wintertime. See, with some people say, well, I'll wait till wintertime to sell the jackets. No. I'll go ahead right now and I'll start selling it now. When they do that, guess what? It starts pushing the trend the opposite way. So they don't care about trends. They care about accumulation and distributing it so that they can keep their money in current flow. All right. So as soon as they accumulate the currencies they want, the banks then periodically sell them off to add momentum to the trends. Okay. Here's the philosophy of banks. They sell to buy, okay, and then they buy to sell. And here's another thing. A lot of them do not use stop losses because if they put a stop loss somewhere in a trade, guess what? Imagine putting $5 billion in a trade, that's coming down. They're purchasing, and then all of a sudden it hits a stop loss because of a trade. Well, guess what? Now everything rushes in and it crashes the market because it's way too much volume at one time. So that's why they periodically do it in steps. They don't care about the trend, okay? Because it's all about that liquidation. That's what it's all about. Just like you don't care what time of day it is you're going to buy them jackets. You either going to come early in the morning, middle of the day, whatever, but you coming in to get that at any time. You don't care if it's crowded. You don't care if nobody's in the store. You're going to come in and get them 5 jackets for $5 a piece because you got the money and you're trying to go get it so you can go ahead and sell it back out on the market, okay? So here's an example because I don't know if you're like me. I need to see some stuff. So I want to go ahead and do this example. So here is a sell trend. So this is when people, all of us, me, you, everybody else, we actually see a trend where the price or the currency is going down. So in this example, let's imagine it's the odd Australian dollar versus the US dollar. When the odd dollar is weak, you're going to be in a trend right here because the US dollar is strong. So the Australian dollar goes down and down. So this is what the bank does. When it gets down in price, this is when they buy. The bank's buying because remember, it's a liquidation for them. So as the price goes down, they're going to get a few billion here. They're going to get a few billion here. They're not doing enough to really shake up everything to do a straight candle down, but they're pushing momentum into the market because they're constantly pulling it out. So this is where you see what you call a pullback. Okay. Remember, you see some red candles going down, but then all of a sudden you see a long green candle, right? That's what the green candle is. This is the banks that's buying. So it shows green and it's pulling back. And then they quit. And then guess what? It continues in its downward trend. All right. They buy some more down here until they've filled up their inventory of what they want. Well, we have enough Australian dollars because it's cheap now, because the price went down. We bought the currencies. Now we're going to sell the currencies back out to other banks and stuff. We're going to sell it out to other people, other banks. So once it gets to the end of the trend, the reason why the trend will turn on you, even though your analysis looks a certain way, even though you've done your confirmations, even though you've done your support and resistance, it doesn't matter. The bank says, we filled up our inventory. We're going to start selling now. So now they turn around and they wait. They're going to wait for the market. Now, they're not going to push it. They're going to wait until it slowly starts going up in a buy. So now when it goes in a buy, guess what? Now the bank sells it because it's higher than this price that they bought it at. You understand? So over here, they might have bought an Australian dollar for 0.125 cents, but up here it's going to be 0.23 whatever. And now that's when they start selling. That's when you start seeing the red candles pull back. And then it goes up. Then you see 3 more red candles. That's the banks they're putting out there to sell. And then all of a sudden people buy and it pushes the currency up. So guys, this is how banks think. This is how they, influence the market right here. Okay. So now, all right, Shawn, we got this information. Now, what do we do? What do we do as traders to understand? Now, we can't go against that. Okay. So you can't compete. My little $500, my little $200-$300. First of all, the bank ain't even worried about my little $300. Okay, they're putting in billions in the market, so they're not really concerned about us. They're just concerned about buying and selling, accumulation, distribution. That's all that they care about. But how can we play with the currency? How can we get into the current so that we can win more, like the banks do? Okay, so I'm going to discuss now what can we do to handle our accounts and how you can manage your losses like a bank manages their losses. So I think that if we get in line thinking how the bank thinks when they have millions and millions of dollars that they have to save and not lose, then if we think like a bank does, guess what? You're going to win a whole lot more trades. Okay. All right. So how to trade to win more. Okay. So first of all, what banks use, what they do is called capital management. Okay. We call it as retail traders risk management. Okay. And so here's the thing. Banks have a very structured plan to manage their losses, okay? Where most of us, here's what our common problem is, and I'm raising my hand because I did it, done it, and heck, at certain times I still do it. Your leverage is too high. Most of y'all accounts out there is 1 to 500 in your leverage. Bring that down to a 1 to 200. Okay, that's one way to handle the management. Okay, number 2 is your lot sizes are too big for the amount of money that you have. Okay. Well, Shawn, we're trying to aggressively grow. We're trying to do these 10 pips and dip. I totally understand. But now that I really look at it, you know, if I think like a bank, they're not doing 10 pips at a time and get in and out. They're really doing a little bit longer play, a little bit more conservatively. And that's what we're going to look at right there. Nothing wrong with that. Because what I say in the next thing is if you scalp, then scalp. If it works, don't change it. That's my thing. If it works, don't change it. Do what works for you. But if you're a longer term trader and you want to win on a longer time basis, then follow some of this of what I'm sharing with you, okay? Typically, bank traders do not risk more than 2.5% of their principal balance, and they look for a 7.5% gain, which equals 100%, okay? So we talked about, and what you hear is don't risk more than 3% of your account. Well, now that I see this, I kind of want to think more of the banks. Maybe I should start looking at 2.5% and then look for a gain of 7.5%. But most of us we try not to lose 2.5%, and then our take profit is only 2.5%. So we're at a 1-to-1 ratio, which isn't going to help us. It's going to make us lose money quicker than we're gaining. Okay. And so that's where banks differ. They're not in the game of losing money. They're at the game of mitigating their losses as much as possible so that if they lose slowly, not abruptly. If they gain abruptly, but they lose slowly. Okay. Number two is, like I said, if you scalp, then scalp. But if you're trying, if you're an intraday trader, which means you're shooting for 30, 40, 50 pips, or you're a swing trader where you're trying to do 60 pips or more, 60, 70, 80, 100, then start using a 1-to-3 risk reward ratio. This is what the banks do, okay? They do a 1-to-3 reward ratio. So let me break that down. What does that mean? So that means if I were to put in a trade now, all right, my stop loss, which is the area that's going to save me from losing money, is going to be 25 pips. I have to have some space because the market doesn't just stop in one area. It dances around a little bit, and you have to give it room to dance around, okay? And so let's say I set a take profit for 25 pips. Well, that means I multiply that times 3 for my win. I need to make 75 pips. So that means if I'm willing to lose 25 pips, every time I win, I should be making 75. By this, you're aggressively starting to grow your account, but you're doing it in a systematic and planned way. All right. 1-to-3 is what you should think about. Try it. 1-to-2 isn't bad, but 1-to-3 is maybe a little better. So what that means is some of you seen, and I was trying it out today. I put it in our Telegram. I was in a trade with Euro odds. Some of you participated in that. EURAUD. I went on our COT report, which I'm going to show you here in a minute, and it was telling me that the euro dollar was in a sell, that people were feeling like, hey, the value was going down. Well, guess what? The Australian dollar, the same people felt the same way, that, hey, it's not strong today. So when I saw two pairs that aren't strong, and that's what the sentiment is, then guess what? That told me this is going to be in a sell for most of the day, which means I need to stay in this to make some serious money. So guess what I did? I put it out in the group. Hey guys, y'all need to be in this. So I did a 1-to-3. I put a stop loss of 22 pips. Okay. And then I put a take profit of 66, 67 pips. I multiplied times 3. So I round to 67. And guess what? I caught about 57 of those 67 pips. So it didn't make it all the way. It started to pull back, and I didn't really want to sit any longer in the trade because I didn't know if it was going to go all the way back up. So I went ahead and took my winnings, and I went, and I made a very nice income from doing that. And so by doing this, I am now systematically managing my losses. Okay. All right. And again, this is the last thing. By having a certain 1-to-3 or 1-to-2 ratio, okay, this will help you in getting more winning trades and filtering out or filtering in good setups. Because what's happening is a lot of us, and I'm very guilty of it, is we're jumping in something that is just dropping. I'm going to just jump and get my 10 pips. And then you find out that you're not getting the 10 pips. And you're like, man, I've had 3 straight losses, and all I was trying to do is get 10 pips. You didn't tell me I'm the only one out here? Look, put a 1 in the chat if this happened to you. You trying to get 10 pips, but all of a sudden, you for some reason can't seem to get 10 pips out the market. You keep turning on you before you get it. Is it just me? Just tell me if it's me now. Okay, don't make me feel alone out here. Okay, well, good. So,
no, I didn't catch you.
Say again.
It ain't just you.
All right, cool, Sean John. Appreciate that, brother. So this is part of it. So again, instead of looking at it as a race car trader that's just trying to jump in and just grab whatever, I'm now thinking like a bank would, and how can I systematically really gauge the type of trades I'm getting to? Well, if I cannot get a 1 to 3 win, then maybe that's not a trade I should look at. Okay, that's just that's kind of like, that's kind of like, I had to say gambling. I just want to say that's like somebody going to the crapshoot and say, if I can't win, if I don't have good odds, I'm not going to do that. You see? And so that's a different perspective as a trader that we need to start looking at, is if my ratio, if I can't feel that I can get 3 times my loss out of here, I shouldn't invest in this. And that's what we say as a trader. Okay. But here's the thing. Instead of calling yourself traders, you really need to look at it as an investor. Why get in the trade if you can't make 3 times what you putting in? Doesn't that make some sense? If I'm risking $100, why can't I make 3? Instead, I got $100 and I'm gonna make $50. Okay, but Sean, it adds up. It adds up. Yeah, but I'm putting my whole $100 on the line for $50. Think about that. I'm putting my whole $100 on the line for $20. Okay. Now, I'm not saying that you need to go big and blow up. Yes, you need to get those, those small pips, start building it up to 200, to 300, to 400. But what I'm saying is, even in your 0.01 lot size, when you're going to grow your account, start looking at trades where you can really get a good benefit. Okay. And that will help you out as far as looking at this from a different perspective. All right. So last thing is, let me make sure the time. Okay, good. So banks use what we call a 4 consecutive loss rule setup. Okay. This is something that I really, really started to resonate with me. Okay. So what it's saying is that, let's say I have an account, I start at $1,000. Just example. You don't need $1,000. I'm just using it for example and educational purposes on this call. So let's say you started with $1,000 and you start at a 0.10 lot size, which means you're going $1 per pip. All right. And so now you're trying to go for, let's say 30 pips, and you have a stop loss of 10 pips. Okay. So we're going 10 pips as a stop loss, 30 pips is our gain. Okay. So what it's saying here is, if I were to put it in and I lose money 4 consecutive times, all right. So I put in the first one, doing 10, I lose $10. So I'm $10 down. I lose the second trade. I'm going for 30 pips. I don't make it. I lose another $10. I lost $20. I lose 30. I lose $40. So what they're saying is, if you lose 4 times, then what you need to do to get back to that $1,000 is you need to cut your lot size in half and then trade until you get back up there. So that's the adage of lose slow and gain bigger. Okay, gain faster. So that means when I get to my 4 trade, I've lost $40 out of my 1,000. All right, doesn't sound like a whole lot, but that's because I'm managing my account. I'm trying to win consistently. That means that now I go from a 0.10 to 0.05. I'm cutting that dollar to now 50 cents per pip. And now I'm still trading, but it's gonna take me a little bit of time, but now I'm gonna trade until I get back to my $1,000. When I get back to my $1,000, now I go back to 0.10, and then I go to my next goal. Okay. So the banks use a 4 consecutive loss rule setup. Okay. That's something I would think about implementing, because what it pays attention to, ladies and gentlemen, is our risk management. Instead, what we do is we lose 4 trades and then we revenge trade. Oh, no, I'm going to up the lot size. Okay, I'm down. I went from $1,000 down to 800. Man, I need to get back to it. So instead of going 0.10, let me go to 0.20. Let me go $2 because I'm gonna get it. And then guess what? Now you lose that trade. So you were losing 10, but now you're losing $20 per trade. Okay. Then you up it again. No, I'm gonna get it this time. Man, I'm gonna get it. So now I'm gonna go 0.30. So I'm gonna go $3. So now you lose the next trade. Now you done lost $30. You done lost $50 in 2 trades where you were losing 10 before. You kill your account. And that's not good risk management. And see, we miss these pieces. And so I want you guys to really get this as far as managing your accounts better. Remember, I always said, don't consider yourself a trader, consider yourself a risk manager. And if you master this part on not losing as much and staying a little bit more defensive, then guess what? You'll win more on the offense. Okay, you'll win more on the offense. So now, I don't want to be just all doom, gloom, or anything like that, like, oh, losing money and stuff. Here's what they also said about, when you win, all right? Start rewarding yourself. When you begin trading and winning, the big mistake that retail traders make is not withdrawing your funds to reward ourselves. The goal is to work to get a principal balance and do not fall below that. So if you put in 1,000, you put in 5, your goal is to try to stay above that. And by implementing some of these rules, guys, yeah, you might get a little bit under it, but the goal is not to start at 1,000 and you be down 500. The goal is be 1,000. If you lose, you should be down, $80, no more than $100, and then work your way back up and really move aggressively. Okay. For everyone, start making goal to get to 5,000. Then after that, the second tier should be 10,000. And then as you hit these goals, start withdrawing that money out. And always keep that initial, if your initial part was 1,000, keep that $1,000 in there and keep building that up. Or, let's say you get to 10,000, we'll keep 5 in, take the other 5 out. Don't trade with everything. That's the biggest lesson that I got, is a lot of us keep everything. Like I'm not calling no names out, but I know some of us on this call have gotten our accounts way over $10,000. Okay. And then all of a sudden I get a call. Shawn, I did something stupid, man. I got $200 in my account. I was like, what happened, bro? How'd you get to 10,000 and you got $200 in your account? Now, and I know that's some poor risk management, okay? We should never be doing that. And again, am I guilty? Let me raise my hand first. Absolutely, I'm guilty, okay? But that only had to happen to Shawn one time, trust me. And I got my game straight after that, okay? But I want you guys to not have to go through that, and you don't have to. If you really focus on the management to lose slow but gain fast, then you're going to be okay. So the thing is, when you start seeing yourself losing like that, then you need to really cut that lot size down and fight your way to get back up. And when you get back to that level, then continue moving forward. Okay. And the reason why you want to reward yourself is, guess what? That helps you to refocus and stay in the game, because this game of trading is tough. Yes, it's simple enough for a 10-year-old to learn, but it takes an adult mindset and a good steady pace and a focus, okay, as an adult to continue to do the long game. Okay. You're not going to make $1 million not losing nothing. And you're not going to make $1 million in this space not taking a few hits. But the thing is, you don't have to get hit hard all the time, okay? You don't have to have $20,000 losses, okay? That's just rookie mistakes, okay? Because guess what? The banks can't afford to do that. So obviously, if they're teaching their traders how to manage their losses well, then that's how they stay the central banks. That's how these banks stay in business even during a pandemic, because they have their capital management systems in place, all right? And so that's basically it there. So let me show you real quick the COT report that I was telling you about, and then we'll go ahead and I'll answer any questions after that. Oh, I got 34 people on, man. It's great to see y'all. Thank you so much for being on. Let's see here. All righty. All right. All right, so this is just one out of a few, but I found this one. This is called dailyfx.com sentiment. I'm gonna do this. I'm gonna get it, put it in the chat. You guys go ahead and copy it. And if somebody could put it in the Telegram for me, I would greatly appreciate that too, so everybody kind of has that. So let me put it here. I'm pasting it. All right, so that's the link right there. Well, let me show you what the banks do with this thing, okay? So first of all, this discusses what I said, the sentiment. Remember when I said sentiment? Sentiment is, how do people feel about their trades? You know, are they fearful? Are they confident? How do they feel? Do they feel like they want to do a buy? Do they feel they want to do a sell? So what this does, guys, is it shows banks and shows everyone who checks out the percentage of people that are in a buy going long, that's the blue, and how many people percentage are in a short or a sell, that's the red. Okay, so banks make their determinations with this. All right. Not only this site right here, guys, has great information. It has so much information, I probably didn't even know what to do with it. I happened to look here and I pulled up Euro Audit, and this is where it told me on the fundamental part what the attitude was about the euro and the Australian dollar. They both said it was both in a sell. So that's where I was able to catch the pips today, because I was looking at this. So as you see, look, it already tells you here, trading bias. It's bullish. And it already tells you that 54% here of people are in a buy position, where 45% is in a sell position. Okay, so it kind of tells you that. So when I start seeing big numbers like this, like Bitcoin, 78% of people are in a long position. Well, guess what? Now I probably will look at it and see, well, man, it's driving the price up. If everybody feels that way, then that kind of influences the direction that it may go. So, hey, I might jump in there and take a look. Oil, crude, bearish. See, it tells you all that. But here's what I really want to show you. Let me go down here. Let's find, that's Bitcoin, that's oil, crude, Ethereum, Euro Chief. Let's look at, okay, let's look at Euro GBP. This is a good pair right here. Hope you guys can see that kind of big. All right, so the blue line that you see right here, this is where the sentiment, this is all of us as retail traders, this is how we're feeling about this trade. So in the Euro GBP, everybody is here up in a buy. They're feeling like it's a buy. They're buying, is pushing it up and all that stuff. But look, as it goes up, as most of us feel it's going up, here's what the banks are doing. Look, the candles are headed down. The candles is the part where it represents the banks or the big money right here. So they're pushing down. And what happens is people that still jump in and going up, it's hitting their stop losses while it's coming down. And it's like, oh man. And then all of a sudden, guess what? They start to jump in and go down for a sell. And look what happens. The market starts to come back up. So it's almost moving opposite of what we're doing. Okay. And so these lines down here kind of explain how many people are net long, how many are net short. And then you have these little dips. So then, you know, this kind of tells, you know, here, as it's coming down here in the sell, people are going to catch some, you know, some pips. So this kind of just gives you an overall, like I said, idea of where a majority of the world is on that particular pair, of where they are in their trading. Now, how exactly do you use it for your advantage? You know, honestly, I don't know. This is something, guys, that, you know, during your journey of Forex trading, this is where you have to dig a little bit. This is where sometimes on the weekend, when I'm not trading or maybe I'm not in Bitcoin, this is what I do, guys. I get on Google, I look at YouTube videos that explain these different pieces of the puzzle. Like, how do I use this? How do I use the COT report? How can I use it to counter trade or whatever the case may be? As you start picking up this knowledge, it's going to help you better understand the market so that you can make wiser decisions as far as your trades are concerned. Okay. Like here, this is a sell that was coming down. Well, guess what? Up here, a lot of people were in the sell position, which was good. So this is probably a good time to have gotten in and get it, because a lot of people were here into the sell doing it. And so you would have caught this nice little trend right here before it started to come up into this buy, as people started getting into the buy part. So this is stuff that you look at to kind of help you out. So it's called the Commitment of Traders, COT report. And again, this is just one of the sites that I found, but you can look at it in other ones. I think TradingView also has this also. So you can look on tradingview.com and kind of explore the market data. I think they have something very similar too, because I remember seeing it. I just didn't understand what it was until this point. But this is what banks look at. This is what big hedge funds and everybody, they look at this and they make their determination as far as how they're going to trade according to what they're seeing. So again, they don't see your stop losses. They don't see, you know, exactly what your little tiny account and my little tiny account is at. They make a basis on where the majority of people, where the popular people hang out. And the point is, you don't want to be popular. You want to kind of work as far as thinking more so kind of how the banks go. Okay. So that's kind of what I had to share tonight,
I have a
guys.
quick question on that.
Yes, absolutely.
Okay, so when you was giving that demonstration and we saw, I think it was Bitcoin you scrolled over that was at 78%.
Let's go take a look at it.
And thank you for giving us this demonstration.
Yes, ma'am. Okay, Bitcoin. Okay.
Okay, so I think you scrolled over and it showed that it was 78%. Oh, and or it showed that one area was at, so 75% of the people were in the buy and the others were in the sell.
Oh, you mean up here at the top?
Okay, yes, right here. All right. Okay, yeah, scroll down. No, you went too fast. Go down a little. More. Okay, pause.
Ah, okay. So right
Okay.
here.
Yeah,
Okay.
so like let's use this Bitcoin, right? That was the one that caught my eye. Okay, so let's use this Bitcoin as an example. So this is showing that 78% of the people that are in the market for this particular move right here was in a buy,
Mm-hmm.
and 21 was in a sell.
Correct.
So based on what I understand you to just say, if the banks or the market movers is going to look like this and make it switch into a sell. So I would look at this and do the opposite thing, or did I understand it wrong?
Yeah. I don't necessarily always know if you'll do the opposite, because you got to understand it as a retail trader, it doesn't help us to do what the banks do. Because remember, we're trying to gain from the trend. We're trying to be in a sell and continue going to sell. What this information does is it gives you an idea of when it may switch a trend on you. Okay. So that's kind of what you're looking at it for. Not necessarily that you can do what the banks do, because you can't, because you're not purchasing currencies. They're doing it for the reason of purchase, accumulation, like I said, in distribution. We're doing it just for the fact of just trading and just getting in. So we can't go opposite, because obviously if we did a buy when they did a sell, then we're negative in our account and is going to fight against us. Plus, if it's a pullback, we don't really know how long the pullback's going to go. So yes, it does make sense to follow the trend. But when you start seeing on these charts that the numbers start to change, let's say you look at it later and this is kind of closer to the short. Let's say it was 45, or like right here, see the AUD USD where it's half and half. So by looking at that, this is going to tell you that's probably ready for a trend change. It's probably consolidating right now.
That's what I was thinking. That's probably consolidating.
So yeah, so we would look at this and then have an idea, looking at our currency strength meter, looking at maybe what the sentiment is of the market. Then we would look at this and say, okay, it's probably consolidating. Let's wait until some news or something comes out and it clearly starts going in a trend. And then when we see these numbers go up, that will give us a confirmation that, yeah, we can probably ride this trend out.
Okay, so then this is just another confirmation for us to add on to our list of confirmations.
Absolutely. Because next week, what I think I'm going to talk about is I'm going to start talking about the fundamentals, looking at news, looking at how we're doing it. Because a lot of us are just getting in the market, support, resistance, trend line, that's it. And that there's nothing wrong with that. But what I want to now have us move toward is starting to investigate these currencies a little bit more, not having to spend hours, but just spend a couple minutes on going maybe to Bloomberg or going to here, or I'm going to break down Forex Factory, because these news things actually are telling us when it goes into its trends. I didn't know that until I started looking into the banks. The banks look at something like Forex Factory. So when the CPI comes out, or when the non-farm payroll comes out, and it's at the actual amount, if it's an actual, and let's say it meets the expectations that they thought, then that pair will move up. And we can see it as soon as the news hits and it moves that way. We'll know that it's going to stay in an uptrend. If it's negative, if it's less than what was expected, then we'll find out that pair is going to go down in a sell. And then we can stay in that for a while, not worried that it's going to change trends on us. So that's what banks do. They actually look at the news and they let the news determine how are people going to feel after they hear this news. Well, guess what? Unemployment rose up. So like now, you could probably look at the US dollar, unemployment rates come out. We're at what? 17 million people that's filing for unemployment here in the United States. So guess what? The sentiment's not good. Dollar's dropping. That means that gold is on the rise. Did any of y'all notice that? I know my boy Doug called it this morning that gold is about to turn and do about another 100 and something pips to the upside, okay, in turn. Why? Because the dollar dropped. And remember, we did correlations. So the dollar is opposite correlation to gold. So when the value of dollar goes down, guess what? Gold goes up. See, all this goes in together. But if we weren't paying attention to the numbers like the unemployment news, we're hearing it, but we're not listening. You know what I'm saying? Y'all hear on the news, oh, today, it's the highest number of unemployment. Well, that means the dollar's going down. Ooh, that's an opportunity for me to jump in gold. That's an opportunity for me to jump in another pair. You see what I'm saying? And now it goes up, and you can ride that for a while because the sentiment is people don't feel great that the U.S. dollar and unemployment is going up. So, and if the dollar's going down, so that means you can be able to ride gold for the next few days and make a killing off of that. So those are the fundamentals that we're going to look at next week on our class, how to read this Forex factory, which news is important, what are some things for us to pay attention to, so that now we're not just going through motions of plugging in numbers, but now we're really getting a whole picture, a financial picture of what's happening in the market. So when you hear these little key terms, you get to start making smarter decisions based on the information in front of you. Okay? Anybody have any other questions? Okay, cool. All right, it's 9:38. Please, guys, this is the place to answer questions. There's no dumb question. Look, if what I explained to you is over your head, that's okay, all right? I'm not here to give you, a PhD in this. What I want to do is just put a little piece of this. We're going to continue in our relationship together, ladies and gentlemen. As you're here with the family, we're going to constantly talk about it. This is like our dinner table talk right here. This is like going to Big Mama, Big Daddy's house, and you talking about this week after week, like Sunday dinner. The more you talk about it, the more it's gonna get into your system. It's gonna get into your mind, and you're gonna get it. So it's not meant for you to understand everything right now. It's just take a couple nuggets, write it down, keep it in your psyche, start investigating it a little bit, start to study it on your own a little bit. That's how you get better. That's how you really get this whole skill of trading down pat. Okay. And so that's what I wanted to share with you guys. I appreciate each and every one of you. For our guests, it's an honor and a pleasure for you to be a part of our Team Wealth Builder family and listen to the information that we have. Again, we're just here to introduce this to you. Your real, where you're going to get your real impact is when you join I Am Mastery Academy. That was the best decision I could make. If I didn't make that decision 3 years ago, I wouldn't be sitting in front of you now. Because of this opportunity, I've been able to retire from my corporate job for the last 3 years, be home every single day with my baby son. For 3 years, he's never known me to be out of the house and have a job or be away from him for any length of time, because I'm always there for him because of this opportunity. And I thank Christopher Terry for that opportunity all the time. Okay. So guys, get started, make the decision, get started, join us so that we can help you go ahead and achieve the dreams and the financial goals that you want, even during a pandemic. Okay. Anybody have any other questions? All right. Well, if there's no questions, guys, and here's what we're going to do. Miss Latia and the whole study group, okay, you guys are going to stay on. And then guess what, guys? They're going to look at charts. And again, this is interactive. This is for you to, hey, Latia, let's take a look at this. Hey, let's look at this. This is not a teaching session, okay? I want to stress that. This is not for Latia to teach anybody anything. This is really to take what you're learning from the academy and be able to look at charts together and make suggestions together and say, hey, I think we can get some pips out of there. Hey, I think we can make some money right there. And that's the goal, is you guys should be making money on that call. You guys should be finding 10 pips, get your 10 pips, everybody agree on it, get on out and go about your day. And trust me, if you guys were to do that every day, every Monday through Thursday that Latia has this set up, and you guys can get 10 to 15, or let's say you got in twice, you saw 2 good trades and you can get 20 pips out of that. Just imagine that in the course of a month, how you'll get down the growth chart and how much you'll grow your account now that you have numerous eyes on a particular trade. Okay. That's the whole point of why we have the study group together. So you guys can, iron sharpen iron, so everybody can get better at this skill set. Okay. So again, it's been an honor and a pleasure. Thank you so much.